Welcome back to Investing Talk Podcast. Today, we're turning our attention to Hecla Mining Company, ticker HL. You sent us a really interesting collection of information, a detailed due diligence report from 2025, some recent news, and a solid company overview. Our goal here is to sort of extract the crucial insights so you get a clear picture of where Hecla stands right now.
That's right. We've got financials from 2024, operational news from early this year, 2025, and that overall snapshot. It should give us a pretty robust understanding of their current position.
Okay, great. Let's get right into their financial performance from last year then. Record revenues of $929.9 million. That's quite a headline number, isn't it? What was behind that kind of growth?
It is significant, yeah. And beyond just the revenue, they also posted net income of $35.3 million. That works out to about 0.6 cents per share. What's interesting there is it suggests they're not just growing sales, but actually turning more of it into profit.
And it looks like debt management was a big focus. The report mentions deleveraging.
That's right. Deleveraging, basically, they've been paying down debt. Their net leverage ratio improved, came down to 1.6x. Just for context, that ratio compares their net debt to EBITDA earnings before interest, taxes, depreciation, and amortization. A lower number, like 1.6x, well, it generally signals a stronger financial footing, less reliant on borrowing.
Okay, that's good context. And strong free cash flow, too, especially from Greens Creek and Lucky Friday mines. Why is that so important for a miner like Hecla?
Oh, strong free cash flow is huge. It gives them flexibility. They can reinvest in their mines, make them more efficient, explore for new deposits, maybe even look at acquisitions or just pay down more debt. It's a real sign of underlying financial health.
Got it. Now, the info didn't give specific PE or PB ratios, but it mentioned general ranges for mining companies. Can you give us a feel for how investors typically value companies in this sector?
Sure. Generally, price-to-earnings ratios for miners, they can bounce around quite a bit, often somewhere between, say, 10 and 20 times earnings. It really depends on the metals. Precious metals like silver often trade differently than base metals, and just the overall market mood towards commodities, price to book. Comparing market value to assets on the books, maybe 1 to 3 is a common range. But these are just general guides. Specifics vary.
And the dividend yield looked pretty modest, around 0.29%. Plus that mention of shifting dividend policy towards growth. What's the thinking there?
That's right. They moved away from a dividend tied directly to the silver price. By doing that and emphasizing reinvestment, management is basically saying they think they can create more long-term value by funding expansion and development. Maybe putting that capital towards projects like Keno Hill, it suggests they see better returns from growing the company versus a higher immediate payout.
Makes sense. Okay, let's pivot a bit to Hecla's place in the industry. Largest primary silver producer in the U.S. and Canada, over 130 years operating. That's a serious history.
That longevity, it really says something about their ability to navigate what's often a very volatile industry. They've clearly adapted over a long, long time. And being the top primary silver producer in those regions, that gives them real scale and, frankly, influence in the silver market.
Their key mines are quite spread out. Greens Creek in Alaska, Lucky Friday in Idaho, Casa Berardi in Quebec, Keno Hill up in the Yukon. Does that geographic diversity help, or does it add complexity?
Well, diversification like that can be a plus. It mitigates risks tied to one specific region. Maybe local regulations change or there are geological issues at one site. But yeah, each location brings its own factors. Permitting, infrastructure, community relations. Greens Creek and Lucky Friday, as you said, are strong performers right now. Keno Hill is the big growth story, but it definitely comes with its own complexities too.
One of their stated advantages is cost leadership in silver mining. How critical is being a low-cost producer in such a cyclical business?
Oh, it's absolutely critical. If Hecla's silver mines operate cheaper than others, they stay profitable even if silver prices dip. That's a huge buffer during downturns. Makes them much more resilient than competitors with higher costs.
Right. And it sounds like the overall industry trends might be working in their favor. Market deficits, strong industrial demand, investment, renewables. How significant is that tailwind?
Those are definitely positive trends. Silver's use in industry, especially things like electronics, solar panels, that's growing. It provides a solid base for demand. As a major producer, Hecla is, well, pretty well positioned to benefit.
Okay, let's look at some recent developments, early 2025 stuff. Q4 2024 revenue beat estimates, but earnings per share missed. How does it happen?
That's not unusual, actually. Revenue is the top line, total sales value, but earnings per share, the profit per share, that gets affected by costs, depreciation, interest, maybe some one-off expenses. So even with great revenue, if costs were higher than expected, earnings could fall short.
I see. The Casa Berardi underground mine. Operations expected to run till mid-2025. What's the significance there? Did that signal a change for that mine?
The mid-2025 timeline suggests they probably have a defined plan for that period. What happens after that? Well, maybe they explore deeper zones, maybe shift mining methods, or maybe they redirect resources elsewhere in their portfolio. It's definitely something to watch in their future updates.
Okay. On a more positive note, big exploration success at Keno Hill and Greens Creek. Silver reserves hitting their second highest level ever, 240 million ounces. That sounds huge.
It is very significant, yes. Glowing reserves is fundamental for any miner's long-term health and growth. Those ounces are potential future production. It boosts the company's valuation and investor confidence, and second highest ever really underlines the scale we're talking about.
And we touched on this, but they formally cut that silver-linked part of the dividend to focus capital on growth. What's the real message there?
It's a clear signal. Management's number one focus is expanding the business, boosting future earnings. By freeing up capital from that silver price-tied dividend, they get more firepower to invest in projects they think offer the best returns, like getting Keno Hill fully up and running.
Interesting. And their stock price jumped in March 2025, seemingly tied to precious metals market moves and investor interest. How tight is that link between mining stocks and commodity prices usually?
Very tight, typically, especially for precious metals miners like Hecla. Their stock performance often mirrors the price movements of silver and gold quite closely. When metal prices rise, investor interest tends to follow, and that can push stock valuations up.
And the report noted H.C. Wainwright reiterated a buy rating. How much weight should investors give analyst ratings like that?
Analyst ratings can definitely influence sentiment. They represent a professional opinion from someone following the company closely. But, it's always wise to look at the why behind the rating and maybe check the consensus view from multiple analysts, not just rely on one.
Yeah.
A reiterated buy generally means that analysts is still positive on the outlook.
Okay, so pulling this together, what are the key strengths that really stand out for Hecla right now?
Several things, I'd say. Strong operations look at their record revenue and EBITDA. That shows they can execute. Their strategic focus on high-return projects like Keno Hill and disciplined M&A suggests a clear path for growth. And of course, being the biggest primary silver producer in the U.S. and Canada, that's a solid base.
And on the flip side, what about potential red flags? Things investors need to keep a close eye on.
Well, while the leverage ratio is better, managing debt is always ongoing work in this cyclical industry. That needs monitoring. And the stock price volatility, it's clearly tied to market swings and commodity prices. Investors need to be comfortable with that potential for ups and downs.
Right. Looking ahead, Keno Hill seems key, but also has challenges, past incidents, energy shortages, possibly delaying big production increases until 2026. How should we view those hurdles?
These kinds of challenges aren't unexpected when developing a mine, especially restarting one. Infrastructure, power, safe operations, these things take time and investment. The potential for delays at Keno Hill, investors should probably factor that into their near-term expectations for production and revenue from that site.
And relationships with local governments and First Nations in the Yukon, those seem critical for permits at Keno Hill, right?
Absolutely critical in any mining project, but especially in areas like the Yukon with significant indigenous communities and environmental focus, strong relationships are essential. Collaboration with stakeholders, regulatory bodies, it's key for getting permits, smooth operations, and just long-term sustainability.
Definitely. And the bigger picture, macroeconomic stuff, interest rates, the global economy, how might those affect metal prices and Hecla?
Oh, they can certainly have an impact. Interest rate changes affect how attractive precious metals are as an investment compared to, say, bonds. And the global economy's health drives industrial demand for metals like silver and also zinc, which Hecla produces. Slowdowns can hit demand and prices.
So for someone following Hecla closely, what are the key things to watch for soon? Upcoming catalysts.
Well, their next earnings reports are always crucial. They give updates on financial and operational progress. And any significant news on Keno Hill development progress, permitting milestones, those will be important catalysts that could move the stock.
And the risks lurking out there for Hecla and the silver sector.
Regulatory changes are always a potential risk in mining, anywhere they operate. And as we've discussed, the inherent volatility of silver and gold prices, that's just part of the landscape, impacting revenue, profit, and the stock price.
Let's touch quickly on competitors. First, Majestic Silver, Pan American Silver were mentioned. How does Hecla compare?
Yeah, those are definitely major players in the silver space. Each has its own mix of mines, geographic focus, different strategies. Comparing their financials, production levels, market cap, that helps put Hecla's position and relative strengths into a broader context. It's not operating in a vacuum.
And it sounds like Hecla is pushing innovation and sustainability. How important is that angle today?
Increasingly important. A strong focus on ESG, environmental, social governance, including sustainability. It helps with regulatory approvals, attracts investors who care about responsible practices, and builds reputation. And innovation, well, that can lead to more efficient, lower cost mining, which is always a competitive edge.
Okay, last point, the stock snapshot from April 8th, 2025. Trading at $4.72, down from early February highs. Recent volatility, mixed over 6 months, generally down over the year. What does that tell us?
That snapshot likely reflects everything we've been talking about, really. The broader market mood for metals, silver price swings, maybe reactions to company news, and those strategic shifts. It just underscores that investing in commodity stocks can mean riding out significant price swings.
And the overall sentiment seems mixed. Optimism on operations and Keno Hill's potential, but caution about market volatility. Did I capture it?
I think that's a fair summary. The fundamental strong reserves, production potential offer reasons for optimism. But those external factors, the cyclical nature of the business, they naturally bring some uncertainty and caution.
So, wrapping up, looking at all this info, we see a company with a really long history, a major player in silver, strong recent financials, making strategic moves for growth, especially with those reserves in Keno Hill. But at the same time, market volatility, operational challenges, those are definitely things to keep in mind.
And that dividend change, eliminating the silver-linked part, it really highlights the focus is now squarely on reinvesting for growth. That's a key factor for investment decisions. But, as you said, the recent stock volatility really hammers home how important it is to understand the wider market and commodity price environment if you're looking at Hecla.
We certainly hope this breakdown has offered a clearer view of Hecla Mining. There's always more detail in their SEC filings, and keeping track of Keno Hill news is key. What stands out most to you after considering all this? We definitely encourage you to do your own follow-up research on anything that caught your interest. And hey, if you found this useful, please do subscribe, like the video, and drop a comment below. Let us know what you think or other companies you'd like us to look at.
Yeah, and maybe a final thought for listeners to chew on. Given Hecla's long track record, this current strategic pivot towards growth, and the undeniable volatility of the silver market, how do you personally weigh that potential for significant long-term reward against the inherent risks you take on in this sector? That's a crucial balancing act to consider.